Okay, so let's hit four main principles here that follow their way through financial accounting. The first one is the business entity concept. The idea is that each business is unique and should have its own financial statements. That means if you were to have, let's just say, a hair salon, an auto repair business, and maybe a dry cleaner, all the records should be kept separately so you can analyze their individual profit or loss. Each one would have its own balance sheet and its assets and its liabilities and such. You wouldn't, each individual activity that you have, each individual business entity would have its own unique financial statements. As well as, just to add to that, is the activities of the owners wouldn't be in there. So, for example, the mortgage of maybe the person who owns those businesses wouldn't find its way into the expenses of the financial statements, all right? Because the financial statements for the hair salon should just be the revenue and the expenses of the hair salon and the assets and the liabilities and the owner's equity of the hair salon, and shouldn't be anything else. They shouldn't have any of the other businesses' information in them, nor should they have anything of the owners in them. Okay, with the business entities, let's talk about some of the main types of business entities. The first one I want to mention is a proprietorship, which is often referred to as a sole proprietorship. If you've taken an intro to business or something along those lines, I'm sure you've heard of these before, so I'll just touch on them briefly. A sole proprietorship is easy. That's what it comes down to. It's easy to start, it's easy to finish, it's easy to organize, because really there's nothing you can do. If I wanted to start selling cookies in the classroom, then I have a sole proprietorship. I've got revenue, I've got expenses. It's easy. I don't have to file paperwork with the government. I don't have to do anything. I don't have to hire an attorney, nothing along those lines. Okay, so as you can see here, 70% of the business entities in the United States are sole proprietorships. They're easy, they're cheap to organize, and they're fast. Now, there's definitely some liabilities that go along with sole proprietorship, but we'll save that for a future chapter. A partnership is basically a sole proprietorship, except for it's not sole, it's owned by two or more people. Now, only 10% of the businesses in the United States are partnerships, and the reason here is really because it's got to be hard to be in partnership with somebody else. Now, what I mean by that is, how many times have you heard of, family arguments that broke out because of a family business or something along those lines? Partnerships are hard because you've got to really, really like the person you're in business with. Really, the only successful partnerships are those that combine unique skills of each person. Now, for example, since my personal expertise is in individual taxation, it would make sense if I were to open up a tax firm to maybe partner with somebody who knows more about corporate taxation. So you're each bringing your own unique skills to the table. Let's talk about another one, corporation. Corporation is more difficult to organize in the sense of there are filing requirements. You do have to organize with the state. You do have separate tax forms you have to file. But the thing is most businesses that are corporations. And as I said, again, we'll talk about the why it's a good idea to be a corporation in the future. But the idea is that here, the interesting thing that I find is only 20% of the businesses in the United States are corporations, but they generate 90% of the revenues. That's huge, right? I mean, think of all those sole proprietorships. The most businesses are sole proprietorships, but they only generate, 10 or 20% of the revenues. So just an interesting piece of information there. A limited liability company combines basically the better parts of a partnership and a corporation. It's easier to organize than a full corporation would be, but it's got the tax and some legal liability advantages of the corporation. But we'll get into that again in a lot more detail in the future. Okay, here's another concept. So that was the business entity concept. Let's talk about the cost concept. You might want to think of this as the historical cost concept. The historical cost concept says whatever you bought something for, if you bought an asset at some point, you're going to record it on your financial statements for what you originally paid for it. Okay, so let's just say I bought a piece of land in a very urban area 50 years ago for $10,000. And that piece of land is, tax assessed for $100,000, but it's really worth $200,000 in the marketplace today. It doesn't matter. What I'm going to record that piece of land for is what I originally purchased it for. You're going to record it for the $10,000 that you originally bought that land for. And that's the idea why I call it the historical cost concept. regardless of what happens in the future, you record with an asset for what you originally paid for it. So just to give you like this little example here, Aaron Publishers purchased a building on February 20th, 2010 for $150,000. Okay, they purchased it for $150,000. That's what you have to remember. Now here's a bunch of information to kind of try to throw you off. Price listed by seller on January 1st, 2010. So the seller originally tried to sell it for $160,000. Aaron Publishers made an offer of $140,000. They finally settled on $150,000, and that was the true purchase price. Now they're going to sell the property maybe on December 31st, 2012, 3 years later for $220,000. Its assessed value of property taxes is $190,000. Both of these numbers are irrelevant. The amount that we're carrying this property for on our books is the $150,000 that we actually paid for it. That's the historical cost concept. The objectivity concept, here's the third one. The objectivity concept requires that the amounts recorded in the accounting records be based on objective evidence. What that means is, you've got objective versus subjective, right? It means the most objective information that you have available to you should be what you take for amounts in your accounting records. For example, what if you were buying a piece of land, but you didn't have any cash? So instead what you did is you gave stock in exchange for the land. Now you weren't really sure what the value of the land was. You thought it was worth about $100,000, but the stock that you traded is on the stock market. It's publicly traded. We know exactly how much the stock is worth, and maybe the stock is worth $80,000. Okay, so you think the land might be worth about $100,000, but the stock that you're trading for the land is worth $80,000. Well, when you make that trade, then you're going to record that land at the $80,000 because that is the most objective evidence, because it's the stock market evidence. Is more objective than the assessment value of the land. Okay, so whatever is the most objective information you have is the information you use. And the last one's kind of funny. It's a unit of measure concept. And basically this is saying that financial statements are going to be recorded in dollars. So financial statements are not being recorded in euros. They're not in rupees. You can pretty much be assured that any U.S. financial statement, when you open it, is recording it in dollars. And it seems silly, but I guess it needs to be said. All right, the accounting equation. The accounting equation has three parts: assets, liabilities, and owner's equity. Assets are the resources owned by the business. So your buildings, your cash, your land, your supplies, the pens and papers, the desks in your office, all of those things are categorized as assets. Liabilities of the company are I like to put it as the liabilities are when you owe somebody something. Liabilities could be you owe somebody money. Liabilities could be you owe somebody services. Liabilities could be that you owe somebody something. That's really the best way to think about it. All right, so you've got assets, liabilities, and owner's equity. Now, owner's equity. The rights of the owners are owner's equity. Owner's equity is a little bit more difficult to describe. The best way to show owner's equity is really through examples. But for right now, the best example I can use for you. Now, take out a piece of paper. Unfortunately, I don't have my writer's tablet here with me, so I'm going to have to ask you to take out a piece of paper. You can pause me for a second. I won't mind. And I want you to write down an asset. I want you to write down maybe the asset you have, let's say, is a house. Okay? And you write down the asset is worth $700,000. Okay? So you have house, $700,000, and that's your asset. Now, what if you were to have a mortgage on that house? Most likely you do in today's day and age have a mortgage on the house. And let's say you've got a $250,000 mortgage. Well, that's your liability. That's the debts that you have on that house. So you've got assets of $700,000, and if you subtracted that liability of the mortgage of $250,000, what you're left with is your equity in the house, right? Assets minus liabilities equal owner's equity. So you would have, what would I say, 700,000 minus 250,000. You would have $450,000 worth of equity in the business, or in the house rather. So you see that accounting equation at the bottom. This is really like the golden equation. Assets equal liabilities plus owner's equity. That's the accounting equation. That is the equation we're going to talk about a lot in Chapter 2. I just want to mention at this point. But that equation, it can be moved around the way we just did it. You can move it around algebraically to be assets minus liabilities equal owner's equity, which is what we just did with the house. The house of $700,000 minus $250,000 of liability gives you $150,000 of equity, basically, in the business. So really, owner's equity is almost what you have left in the business after you pay off everything that you owe. So it's kind of what's left over. So here's the accounting equation. Assets equal liabilities plus owner's equity. And as I said, you can move it around because it's just simply a very simple equation. Okay. So let's talk about the accounting process. The accounting process begins with a business transaction. Something happens. Whether you sell a product or you get something you bought in the mail or you buy a building, that's a business transaction. Something has happened that has changed the financial condition of the company, and you need to record it. And that's what we'll get into journal entries with the recording part of that in Chapter 2. All of these business transactions are basically accumulated, and then we prepare what are called financial statements. Now there are 4 main financial statements, which the first one is the income statement. An income statement shows revenue, how much money you earned, minus expenses. What expenses did you have to earn that money? That's what pretty much what's showing on the income statement. And please don't stress too much about this just yet, because we'll spend an entire chapter talking about these and creating them in a lot more detail. But just to give you a high view, an income statement is where it shows your profit or loss. Did you make money for a period of time, whether it's a year or a month? That's your income statement. On the income statement, you're matching revenues against the expenses. So as I said, the income statement shows a period of time, maybe it's January 1st through December 31st, and it shows you how much money did you earn during that period, and that you match the expenses against the money that you earned. So what did you spend in order to earn that money? That's the matching concept. And we'll hit that a lot harder in the future. The retained earnings statement shows how much money from what you've earned are you keeping in the business. Okay, that's called the retained earnings statement, or the statement of retained earnings. The idea is you're making money and you're earning money. You're showing what you earned on that income statement and what you've kept in the business by showing your final profit or loss. Now, how much of that money are you going to keep in the business to further your operations? That goes on this statement, statement of retained earnings. The next statement is the balance sheet. The balance sheet shows all of the assets of the business, all of the liabilities of the business, and the stockholders' equity, how much money is staying in the business as of a specific date. So this isn't for a period of time. The income statement was showing like all of the revenues and expenses from, say, January 1st through December 31st. The balance sheet, though, would only show basically a picture of that day and time, December 31st, 2010. These are our assets, these are our liabilities, and this is our stockholders' equity. Okay, and the reason you're doing that is basically a balance sheet is a snapshot of this is where I stand today. Because the very next day, more business transactions are going to take place, and the numbers are going to change. Okay. The statement of cash flows, we're really going to hit more managerial accounting, so I just want to mention it here. What the statement of cash flows shows you, and it's the 4th and final financial statement, the statement of cash flows shows you where is cash, actually cash, going to and coming from. And it consists of the 3 sections: operating activities, investing activities, financing activities. In operating activities, it's saying, did you earn the money that you're spending through operations? Are you bringing in money through operations? Are you spending money through operations? The operating activities are basically the core of your business. Investing activities are, did you invest the money? Are you investing in other companies? Is that where money's coming from? Are you buying and selling stock of other companies? That's investing activities. And financing activities are you doing things? Are you issuing your own stock? How are you financing your business? Are you issuing your own stock? Are you buying your own stock on the marketplace? Are you issuing bonds? Things of that nature. That's it for Chapter 1. Good luck.